Ed, thank you for being with us this morning. Man, the administration has a tough job, and I'm curious how you think they're doing. I mean, between this now reported upon, further release from the Strategic Petroleum Reserve, from the back and forth with Saudi Arabia, what kind of grade would you give this administration and how it is dealing with what was a climbing market for gasoline prices?
Sure. So the grade would depend on actually what you're looking at. In some respects, they get a very high grade. They've managed to actually help engineer the drop in oil prices that we've seen since Brent reached 130 last spring with the height of the first disruption of Russian supply. How they've gone about it is a little bit bizarre, however. Sometimes they've antagonized producers. I think the price cap issue is the one on which they get the lowest grade so far. Price caps have been tried before. They were tried when the Iran-Iraq war broke out, and they were designed by the IEA to keep oil prices from running up. And they had the reverse effect, actually. So the history of trying to put a price cap on is not very good. And it's kind of ironic that they're doing this at a time when the producers look at them and say, hey, they're putting on a price cap. We're trying to put a floor under prices. They don't like that. Why should we like them putting a price cap on Russia when they could do the same thing to us if this kind of thing works? So it has mixed grades, I think. Is there any time frame in which this would actually kind of show up for end consumers, people who are using and are reliant on this actually doing something on the pricing front? Sure. Well, let me give you a perfect example. So the U.S. and allies decided to release 200 million barrels of strategic stocks. They did that when prices were exorbitantly high and there was this distortion in the market with European companies and the U.S. avoiding imports of Russian oil. Prices went up. The release of the strategic stocks actually increased total stocks available in the commercial market by around 200 million barrels. If you look at where the stocks were in the OECD at the beginning of the year and look at where commercial stocks are now on land, floating inventory and in transit moving from the seller to the buyer, it's up by around 200 million barrels. And we're actually relatively high in terms of total oil that we measure in high frequency data. We're relatively high in terms of the last 5-year average. So they've succeeded, and we've seen the gasoline price come down. They're confronting another set of problems right now, one being that the European Union has decided to have no imports from Russia starting on the crude side, starting on December 5th. And that is already triggering a kind of buying spree. We've seen a growth in the premium of wet barrels of Brent against screen barrels. So we're seeing a bidding up of the price in the Atlantic Basin, just as we did last March. The price cap is designed to alleviate that, telling companies that if they can buy at a price below whatever the cap is on Russian crude, then they can have an exception to the embargo. But then they didn't think through what would Russia do. Putin said, they put on this cap, they put on the embargo, and we're just going to drop our production. And to prove the point, they clearly stopped exporting natural gas to Europe when Europe said they were going to put a price cap on natural gas and stop importing it sooner or later.
Ed, I have a story on the Yahoo Finance homepage right now. Home Depot's co-founder, Bernie Marcus, criticizing the Biden administration for not letting, the administration not being encouraging to drilling in this country. But the other side of this coin is that oil companies may not be drilling as much as you would think in this environment. What do you think is true? What do you think of that take?
So it really begins with what happened. Historically, we had a pandemic. At that pandemic's time, U.S. production of oil and natural gas was pretty high. We were growing both at a rapid rate, about 1 million plus barrels a day per year. We had hit 13 million barrels of production in the early weeks of March 2020. We had a price collapse. We had negative pricing. U.S. companies stopped drilling. U.S. companies are in what we call short cycle oil. We also had a bad hurricane season in 2020, and that 13 million barrels a day of flows turned into about 10.5 million barrels a day by the end of 2020. We've been rebuilding since then. We're back to 12 million a day. On the natural gas side, we actually have hit a record level of production ever. So I think the constraint there is not even conservative investments by companies because of so-called shareholder requests to return capital to the shareholder. No, on natural gas, the only constraint in sight is a lack potentially of pipeline capacity to move it to the export market on the Gulf a couple of years from now. The return of oil has been slower. It's partly a function of the discipline, the so-called discipline that some companies are imposing on themselves when it comes to drilling, but there are leading and lagging indicators. We actually think the amount of drilling taking place now will give rise to a hefty increase in production this year of around 700,000 barrels a day of crude oil, 500,000 barrels a day of natural gas liquids, so over 1 million barrels a day contribution. Similarly, next year. So we're coming back. But the U.S. would have been producing closer to 15 million barrels a day today had there not been that collapse in drilling that took place in 2020.
Right, which has to do with the pandemic more so than some of the other factors, perhaps.
Exactly.
Ed, I want to ask you about this winter, both in Europe and in the United States. It feels like of course, they're bracing for an energy crisis this winter with the spike in natural gas prices. Here in the Northeast in particular, there's talk about potential blackouts or brownouts as well. What are you expecting? Can you paint the picture for us?
Sure. It's called weather. We've managed not to have the weather that would have hit the world in a significant way had the U.S. had a hurricane season. Yes, my fingers are crossed, and the hurricane season is not technically over until November 30th. But if we were to have a big hurricane season, little factoid in the market that people haven't noticed would really be impactful. That little factoid is that when Europe moved away from Russian gas, they started buying, oil. They started buying U.S. oil. U.S. was a gross exporter of around 7 million barrels a day last January and February. 5 million of that was product, 2 million of that was crude oil. We now have been hitting over 11 million barrels a day some weeks in exports, and we're averaging closer to 10 million a day. And our exports of crude have doubled from 2 million a day to 4 million a day. So we have become the residual incremental supplier to the European market as this reshuffling is taking place. If we have cold weather this winter, there are two different effects. One is on the gas market, and the other is on the oil market. On the gas market, undoubtedly, we have healthy European stocks. That's one reason on the inventory side why European prices have fallen by about 40% from their peaks of a couple of months ago on the natural gas side. But a polar vortex would wreak havoc in Europe and would have an impact in the U.S. and the Northeast in particular. In Europe, governments, particularly the UK government, but other governments in Europe as well, are subsidizing the cost of electricity. That means they're subsidizing the cost of gas. This isn't a question of subsidizing and protecting the consumer. The question is, what do you do when you run out of material? So that's the real danger of weather. With the absence of a flow of gas from Russia, a limited amount of storage, however full it might be now, if we get 1 or 2 cold spells in Europe, the inventory simply won't be there, the deliveries won't be there, and there will be blackouts. So that's one of the factors. The other on the oil side is that we have had a bizarre thing happening, a shift that is really remarkable, namely that natural gas prices around the world, except for the U.S., have risen to the point where it's cheaper to buy diesel than it is to buy natural gas. So we're seeing a lot of fuel switching. Europe is encouraging utilities to move back to using oil, to burn oil. They burned very little oil last year, which was also, last winter was also a tough one. We don't know what the fuel switching capacity is, but diesel prices are high in part because of an anticipated increase in demand for diesel fuel for power burn. And remains to be seen whether that will actually happen.